the limitless sky. I am the inspiration that led success soar high. I will achieve, I will fly high. I am the I in SBI.
I'm backed by the nation's trusted bank, SBI, the banker to every Indian.
Hello and welcome to the Business Standard Banking Show. I'm Ishan Gera. In today's episode, we shall discuss the significant developments of the week. We have an interview lined up with Krishnan, MD and CEO of South Indian Bank. In our Banking for You section, experts explain how to use UPI on feature phones. Our banking expert Tamal Bandyopadhyay sheds light on the new rules concerning asset reconstruction companies, ARCs. At the end of the episode, we shall discuss the last poll's results and ask you the question for the next one. So stay tuned. But first, here are the significant banking developments of the week. On Tuesday, the Bank of Baroda announced another rate hike for fixed deposits. The interest rates on certain FDs were raised by 100 basis points or 1%. Axis Bank initiated its second rate hike in November to catch up with the FD rates of other institutions. The fixed term deposit for 15 to 18 month maturity was increased to 6.4%. While credit growth has kept pace, deposit growth has been lagging. Hence, banks are moving fast towards deposit mobilization. In the long run, this can benefit customers as it translates into higher returns. One thing which is not beneficial is the higher rate of inflation. Although consumer inflation dipped to 6.8% in October, it was still higher than RBI's upper band limit of 6%. Even the RBI governor pointed out that October's inflation would dip below 7%. The central bank projects inflation to come below 6% in the last quarter of this fiscal. Any deviation from the path would entail more aggressive rate hikes. Another factor going in India's favor is Federal Reserve's action. The US inflation print came in at the lowest level since the start of the year, showing some reason for optimism. This is good news for the rupee as well, which witnessed heightened volatility over the last month and a half. A BS poll found that the rupee will end the calendar year at 81.68 and remain stable at 81.75 by the end of March. Much like the currency, India's Unified Payments Interface or UPI is also finding stability. Innovation in this space is driving volumes. Google Play on Friday reportedly enabled the UPI autopay feature, which will help users conduct recurring transactions using the platform. The service is expected to give a fillip to UPI transactions. However, the government would also need to look at the security aspect. An MHA report highlighted that 140,000 frauds were reported in the first and second quarters of 2022. Any discussion on loan growth cannot be complete without discussing banks' profit. It has been a stellar year for banking sector. The net interest margin at South Indian Bank was at a 30-quarter high. Business Standard's Manojit Saha had a discussion with M Ramakrishnan, MD and CEO of the bank, on the future course of action.
Hello and welcome to the Business Standard Banking Show. The second quarter was kind of a turnaround for South Indian Bank, with loan growth picking up, net interest margin hitting 30-quarter high with a sharp moderation in slippages. M Ramakrishnan, Managing Director and CEO of South Indian Bank, is with us today to tell us about the roadmap of the bank. Mr. Ramakrishnan, welcome to the show.
Thank you, sir. Thank you.
After 2 very difficult years, the second quarter numbers are heartening for the banks. Do you expect the current financial year to be a normal one, or there are some headwinds you see down the line?
Normal year, in a sense that it's a normal year compared to last 2 years, what we had experienced as COVID for the entire banking system. But then having said that, I think still we are in the face of a little bit of abnormality because of the war going on and its impact on inflation across the world, including India. Because of which there are changes which have been brought in by our central bank and by continuously revising the repo rates. To that extent, you are seeing a lot of turbulence in the way the reference rates are moving up, which would mean that we need to constantly reprice our both assets and liabilities, and we need to manage the spreads and the slippages, etc. suitably, because as you know, when the repo rates keep going up, the reference rates keep going up, the end rate for the customer will also keep going up. So to that extent, the customer would start feeling that he has to pay more for the same level of loans. And on the other side, the liability holders, people who hold deposits, they might feel that with inflation hitting them, they may not be able to earn real income. So we need to keep revising the liability rate. So how we actually manage these two, and how we ensure that banks like ours, which have a legacy issue to be still sorted out, which we are continuously doing, how these things will be managed is something which we need to keep doing continuously.
Now, coming to the stressed asset portfolio, what is the stress you see in the restructured book, that is assets which are in the SMA 2 category? I'm trying to understand what is the percentage you expect to slip from the restructured book.
Yeah, we have a restructured book. In all, we have close to 2,000 crores now. 1,997 crores is the kind of restructured book which we have. And this restructuring book has come from various types of restructuring which we were doing as a bank in the last many years. If you look at it, Kerala specifically had 2 years of consecutive floods, and where the government permitted a flood restructuring. Then we had this SME restructuring, MSME restructuring due to GST, etc. That is something which was there. And then COVID hit the entire banking system, because of which ECLGS was given, both COVID-1, COVID-2. There are many schemes which were floated by the central bank, basically to keep funding the small and medium companies, because they are the ones who were majorly hit due to the business model going in for a toss due to COVID situation. So if we were to combine all of this, our restructuring book, which used to be in excess of 3,000 crores, have been continuously coming down. It is now close to 2,000 crores, 1,197 crores, from which, as I keep giving guidance on this, I expect a kind of 25% kind of slippages. This book was 2,400 crores when we started, when we looked at June, and I had given a guidance of 600 crores slippages to be happening from my restructured book, and 1,000 crores of slippages happening from my regular book, with which I was giving a guidance of 1,600 crores of slippages for the full year. I'm happy to say that we are still holding on to the same guidance.
But what is the proportion of corporate loans, total loans now, and where do you see it by let's say end of the financial year?
Currently, it is at about 30% of my total book. See, there are many banks whose corporate book is close to 40%, 45%, even 50%. So I am not in a tearing hurry to really say that it is high or that we need to worry about. So long as good quality corporates are available and it is meeting with my NIM requirement and ROC requirement and ROA requirement, I'll be happy to deal with them.
So what is the overall deposit growth and credit growth target you have for the current financial year?
See, I am looking at a double-digit growth for my assets book. So I am looking at adding. We ended last year with a 61,000 crore kind of book, and which we ended in June quarter at about 64,500 crores. We ended September quarter at about 67,800 crores. I am looking at close to, let's say, 71,000 crores is what I'm aspirationally looking at by the end of this year. I'll continue to work on CD ratio of something like 74%, 74%. So suitably, we will raise our deposit base. So I'm not putting a percentage growth over there. Rather, I would work on my cost of deposits as a criteria and my CD ratio as a criteria and my CASA as a criteria.
I'm coming to the cost of deposit part, because you said your net interest margin was a 30-quarter high at 3.2%, but your overall target for the year is 3%, which means there could be some deposit rate hikes going ahead, which could eat into your margin.
We have already done that, sir. We have already done a little bit of increase in rates in the bands where we want to bring some traction. We have done that even in our FCNR deposits. So rates have been revised. And that is a continuous process. I'm holding 2 to 3 ALCOs every month to continuously look at where we need to intervene and tweak the prices.
2 to 3 ALCOs every month. Earlier, I think there was only 1 ALCO, but now the situation has changed so much.
Yes,
one has to have 2 to 3 ALCOs every month. That's very interesting.
Correct.
That's very interesting. Now, finally, we would ask you that your capital adequacy ratio is at 16% at the end of September, which is much above the regulatory requirement. Given the loan growth that you would expect, do you think there is a need to raise capital in the current financial year?
Yeah, I think if we are continuing to target growth of double digit, I think I'm sure we need to carefully look at what kind of profits are we going to generate in the next 2 quarters and how our capital adequacy, we need to do a planning of how our capital adequacy will look with the same trend of, restructuring my overall portfolio composition, which will help me to sort of predict what would be my CRAR, etc. So I would definitely anticipate that we may have to raise capital. Any sensible bank, when it is targeting double-digit growth, we need to keep raising capital. We need to equip ourselves with the good capital, so that capital adequacy is one of the important parameters for a bank's strength. So certainly we are very closely looking at the opportunity as to what timing and how much quantum and through what route we would want to raise. I've already got an in principle approval from AGM as well as board to raise 2,000 crores of equity. So we don't need to really do any work over there. It's just a question of when and how much and through what route.
Okay, on that note, thank you, Mr. Ramakrishnan, for speaking to Business Standard. It was a pleasure talking to you, sir.
Same here, sir. Thank you so much, and thanks for taking your time out. Thank you so much.
Ramakrishnan says that we are still in the phase of abnormality given the war and high inflation worldwide. He points out that it is still a normal year compared to the last two. It has in no measure been a typical year for UPI transactions, which have consistently been over 10 trillion rupees each month. In October, the value of transactions was 12.11 trillion rupees. The government is trying to ramp up usage further and take the ecosystem beyond smartphones. In a Banking for You section, experts explain how to use UPI on feature phones.
Unified Payments Interface has been one of the most revolutionary innovations in the Indian banking space. Powered by the National Payments Corporation of India, it allows users to transfer money from one bank account to the other via a mobile application. In India, the number of UPI transactions and the value of total transactions have been going up since its introduction in 2016. In October, over 7.3 billion transactions took place through UPI in India. The total money transferred through UPI in the month was 12.1 trillion rupees. However, it was soon discovered by the Reserve Bank of India that as UPI caters to the needs of smartphone users, a large part of the Indian population that uses feature phones cannot avail of the facility. There are around 400 million feature phone users in India. For this, India's central bank came up with a solution. In March, RBI launched the UPI service for feature phones called UPI 123 Pay. It allowed the users to use UPI via 4 options. These were using the UPI 123 Pay mobile app, giving a missed call, using IVR numbers, and based on proximity sound. In the last method, the users tap their mobile phone on the merchant device, which then emits a unique tone. Then, the users need to press hash and enter the amount to pay, followed by their UPI PIN to complete the transaction. But before using UPI, users are required to create a UPI ID. First, call on *99 hash and choose your bank name. Then enter the last 6 digits of your debit card and your card expiry number. After this is done, you will be asked to set up your UPI PIN. Now, your UPI ID will be activated. Dial the IVR number 08045163666 on your mobile and choose the bank linked with UPI. Now, press 1 to confirm the details. Press 1 again to send money by using your mobile number. Then, enter the mobile number of the recipient and confirm the details. Now, enter the amount that you want to transfer. Enter your UPI PIN and authorize the money transfer. The money will be transferred. The feature phone users can avail of a number of facilities. These are money transfers, merchant payments, mobile recharge, FASTag recharge, and other utility bills. In September, at an event, Praveena Rai, Chief Operating Officer of NPCI, said there are currently over 2 lakh UPI for feature phone users.
I am the blue of the limitless sky. I am the inspiration that lets success soar high. I will achieve, I will fly high. I am the I in SBI.
I'm backed by the nation's trusted bank, SBI, the banker to every Indian.
Feature phone customers can use the UPI 123 Pay feature to avail of several facilities. These are money transfers, merchant payments, mobile recharge, FASTag recharge and other utility bills. Meanwhile, as choices are expanding for customers, there has been a contraction in the insolvency world. Once the primary tool of asset resolution, asset reconstruction companies have lost sheen and been replaced with insolvency and bankruptcy court process. But India needs all its processes to work for a faster resolution. A banking expert, Tamal Bandyopadhyay, explains whether the new rules can change the landscape for ARCs. Hi Tamal, thanks for being on the show.
Welcome back, Ishan.
Thank you. Now, this week's column talks about ARCs, and it's a very interesting column because ARCs have been losing their relevance over a period of time ever since IBC has come in. Would the new rules revive the sector?
Yeah, but I mean, you're quite blunt. Yes, it's ruling. It's ARC as an industry losing its relevance because of they have not done much. Some of them are taking shortcuts of be in the business and making money. And if you see, there are 29 ARCs, only 4 of them actually have about probably 80% of the market. And the market is less than $1 trillion, probably 85,000 crores. The focus is new rule is in one word is governance. 2 words, transparency and governance. Will remain. There are too many doing too little. So we'll see slowly. The shake-up is too a strong word, but I think we'll see exit of many slowly. And those who are there, they need to conform to the norms. They need to be well governed. They need to be responsible, which some of them have not been.
You talk about directors. Now, independent director institution in itself hasn't performed too well and hasn't had its fair share of problems. So why do you think appointing an independent director as the chairman will change things?
No, ideally, I mean, who is that also the person? No? Yes, you are right. I mean, there are many cases. ICICI Bank during Chanda Koch's time is a case in point. I mean, she was being defended by the board continuously till the end. So yes, historically, independent director does not ensure that governance and propriety and transparency maintained, but certainly it's far better than nominee director. An independent director is a very critical part. I mean, the chairman being, but then there are multiple committees which were not earlier the case. So it was running sort of, maybe I'm sounding too harsh, but it's a mom and pop stores. But now there is real governance and transparency. So things will really get better and only the serious players will remain in business.
In another instance, you talk about how the board has been disempowered in the case of one-time settlement. How will this impact ARCs?
Certainly, because the one-time settlement is a very critical part of it, and many of the one-time settlements, those who are very close observer, they say they are gaming the systems, or rather, let me correct it, not many. Some of the one-time settlements, there's the troika of the lender, the original lender, and the borrower, meaning and the ARC itself. So they were gaming the system. So I am an ARC, I am buying it at a discount, and then I am selling it at a further discount. Now, why do I do it? Because I maintain my cash flow. So those things now have been taken care of. You need to have committee, which they are calling independent advisory committee. So there are many, many checks and balances. So this is one of the many malaise that was affecting the asset reconstruction industry in India. So I think that's been taken care of. Now you can't do that. So it's too micromanagement, I would say, what RBI has done. But unfortunately, the regulator had to step in.
Now, one part that you talk about is gaming the system, right? Gaming the system, what reminds me of is the security receipt structure and the incentives that ARCs used to get. How is that changing? How would that system change?
Some of the cases, the NBFCs, they were actually offering certain incentives, which is outside it. So what is happening, like I am an ARC and you are an NBFC. Now you sell your asset to me. Now what happens is this, I keep 15% with me and 75% I give it back to you in the form of so-called SR or the security receipts. And then what happens, whether I am recovering the asset or not, you keep on paying me some kind of management fees. It could be between 1.5% and 3% through the life of that asset. Now, why do you pay this? You pay this simply because you are shifting through the SR, you are shifting it from your loan book to your investment book, because you are investing in SRs. So that's the catch and gray area as far as the lenders are concerned, be it a bank or be it an NBFC. You ask, what is the SR? SR is nothing but an instrument where an entity, a lender, actually shifts a distressed asset from a loan book to its investment book. Now, in the loan book, it comes under the so-called NPA, bad assets. So you do a sort of cleanup. So I have impeccable loan book. I've cleaned up, but it's all quietly shifted to my investment book. So that has been the case or practices in many cases. And there was a sort of, I would say that if I'm an ARC, even if I'm not recovering, I was earning some fees from you. That's been stopped now. It is linked to recovery.
An interesting proposition that you talk about is ARCs acting as resolution professionals. Is it a survival strategy for the sector?
Well, it came to the light because one of the court judgments actually, came against it. They did not allow this to happen. Now, Reserve Bank of India is saying, yes, you can do it. You can do it, only there's a time frame within which you need to settle it. And of course, you need to have 1,000 crore capital. Now, if you ask me, if I'm an ARC, why would I get into this resolution? Why do I need to wear a resolution professional's hat? Because that's not my core competence, right? So I think prima facie, it would not make any sense. And only in those cases, if there's a strategic buyout, you have already lined up a buyer for that, you will get in there. So that, it's very smooth. Otherwise, you will take over a company and will nurture it and bring it back to health, then you will sell it off. It doesn't make any sense.
That's about it. Thank you. Thanks a lot. It's always great talking to you. We hope to see you again next week. Thank you.
Thanks, Ishan. Thank you.
Tamal does point out that the rules will see the quiet exit of many and ensure that only serious players with adequate liquidity and patient capital remain in the business. He also says that the increase in capital requirement may dampen the ARC's enthusiasm. Last week, we asked you a question about people's enthusiasm for cash and whether the RBI's central bank digital currency or CBDC could bring a shift away from cash. The response has been encouragingly in favor of CBDCs, with 68.7% responding in the affirmative. But to achieve a shift away from cash, CBDC transactions would have to be seamless and easy. This week, we want to veer you on RBI's ability to contain inflation. Do you think RBI will be able to manage inflation below 6% by March 2023? You can respond on Twitter, Instagram, Telegram, LinkedIn, and our website. The poll will open on Friday. The inflation print dipped slightly below 7% in October. The central bank has set a target of 5.8% for the last quarter of the year, still above the 4%. We'll be back next week with more news and analysis. Thank you for watching.
If you like this video, share it and subscribe to Business Standard. For more news, views and insights, log on to www.business-standard.com. Do also follow us on YouTube, Twitter, Facebook, Instagram, Telegram and LinkedIn.